You're on. Go.
Cheers, we thank you. Okay, so credit insurance. What is? I'm going to go through what is it, who's in the sector, how it's priced, brief insolvency about what's going on in Ireland at the moment. What do we see it might be coming down the line, or what's in the future, and then if there's any other products that are connected to this space that we work on, right? Um, what is it, right? So credit insurance indemnifies sellers when trade receivables are not paid for by buyers or debtors. And that's fairly obvious. So in other words, credit insurance covers the risk of loss caused by a buyer's insolvency or if they default in payment. Indemnity, as Declan alluded to in his is a 1,900,000 scenario, it's about 90% on average. You can get lower percentages. You can have cover that does for political risk, which can go up to 95%. But as Declan says, if you've got 100 grand debt and the insurer has covered it, you get 90 grand back in the scenario of a claim. But it's not just about having claims, and this is what's beats us up a little bit sometimes. Everybody thinks, oh no, I don't need to have credit insurance because it's just about claims. It's not just about protecting against bad debts. The sales pitch is that the underwriters, the credit insurers, believe that they would have more information about your customers than you do.
Yeah.
So I'll tell you who they are in a minute, but like you'll know the names, a lot of them, right? They would have not just the publicly available information that might be filed at the CRO or a company's house in the UK or wherever it might be in whatever country. They would also have management information. They'd have trading patterns. They'd have exposure level. They'd know how much risk might be being written on a certain company and whether they've ever defaulted or been reported for being slow payers. They'd also go out in countries around the world and get third party local companies to give them a report, which could cost hundreds to get the report, but the insurer buys them and shares them through their platform as a grading system on buyers around the world. And they also have debt collection. Some of the insurers have in-house collections services and legal teams. So if you do end up in a situation where you have to pursue it, you don't have to hand it to a solicitor yourself. As part of your policy, there could be a discounted debt collection and or legal services as part of it. So they would see themselves as information providers, debt collectors. Yes, they cover the bad debt risks as well. But overall, they see it as a package themselves. The insurers would see it as. Types of cover you can have. So there's a few different. The main policies are single risk, where you've got one buyer is covered. So you can look at your debtor book and go, where we are constantly out here for 1 million or 2 million or 10 million, whatever the figure is, and it's an imbalanced risk on your portfolio, and you're looking at the debtor book going, oh, we really need to insure this because if that goes, we all go. That's a single risk, right? Multi-buyer, you could have 6 or 7 customers covered. We call them buyers, but customers or debtors covered. Where you're just being selective. You're saying, look, I'm only concerned about the big ones, or sometimes which insurers don't like is I'm only concerned about the slow payers, right? So I want to cover those. So you can isolate your policy to tailor to manage that. And then there's whatever most of our customers would be. Like, I'll give you an example. We have out of our 100 and something customers that we have in the Dublin office and or one of the Belfast office as well. But I look at them, I'd say probably 4 single risk policies and the rest are whole turnover policies. And that's where you're covered from the ground up, from the base level up, above an excess level of 1,000, 2,000, whatever the figure you want to choose, and everything is covered. So if anybody doesn't pay you, or anybody causes you a problem, or anybody goes out of business, you have an amount that you can claim against the policy. And that's whole turnover policy. Who's in the sector? So again, just trying to expand just an understanding of what. So the insurers, obviously there's insurers, right? So we've got Allianz, Coface, Tradius, Allianz Trade used to be called Euler Hermes. So those three, the top three, all have offices in Ireland, right? And they're also probably the top three from an amount of exposure and or premium collected. They talk about how much money they get in. We talk about how much they're actually insuring. They would be the largest in the world, and they have, I think, Coface has 70 offices around the world. Like they're big operators, right? They have offices or partners in quite a lot of countries around the world. And there's Tokio Marine, Credendo, Chubb, QBE, XSAIG. There are other operators around that as well. Most of our client base would be in the top three, and then we'd have about 20% of our customers would be in the others, mixture of the others. So insurers cover the risk. Then you've got the funders. So if you think of somebody who's an invoice discounter or factoring, so you've got all the way from your AIBs and Bank of Ireland's down to the second tier and third tier lenders, anybody who does invoice discounting where they're covering the risk with the security of your debtor book, they tend not to want to cover that risk themselves. as Declan alluded to, it's quite a big asset. They don't want to take the risk that you're going to collect the debt and get it back on time. So what they try to do is they try to get some customers of theirs to put in a credit insurance policy in the background. Some of them, Renke, Close Footers, Capital Flow, some of them have their own bad to Bibi. They have their own bad debt protection that you can buy off them. But the reason you can buy it is because they bought a credit insurance policy in the background. So they themselves have their own policy. So it depends on which way you want to take it. Most of them will say, especially if I go back to Ulster Bank, we can talk about them because they're not active anymore. But Ulster Bank wouldn't have allowed you have invoice discounting with a debtor book outside of Ireland and UK. So any of the buyers that are outside of Ireland and UK, you have to have them covered by credit insurance. That was their black rule, absolutely, no matter what. So anybody, anytime I ever got a call from Ulster Bank, it was generally about outside of Ireland and UK debts that they had a customer with risk there they wanted it covered. Then you've got your suppliers and suppliers in general. So about 15 billion of trade is underwritten by the main insurers in the Irish market, right? That's about 50. I think it is 50 billion, isn't it, in turnover? Yeah, 50 billion annual turnover. Sorry, Declan, your face is blocking my wording. So, just making sure I don't misspeak. And then there's brokers. So like myself. So we are the only broker that's left in the country that's just does credit insurance. We're specialists in credit insurance and bonds. That's all we do. But most of the general brokers will have the bigger ones certainly will have a credit insurance team or person in the business. Right. So that the brokers is the other people in the industry. How is it priced? So credit insurance is the main way it's priced is around the estimated insurable turnover, right? So that is, you might turn over 10 million as a company or 100 million, doesn't matter, whatever the figure is. If you turn over 10 million as a company, but 5 million is in cash, pro forma, retail, whatever you want to say, money up front, no credit risk, and the other half is credit. So it's the credit risks element. I give you an example of a company, a client that I have who has in the same business, the same family, they've got a SuperValu, a hardware store, and a farm supply. They don't insure the farmers because they don't pay them inside 180 days. There's no point in trying to insure that. They just have to meet them down at Mass or the pub. They've got the SuperValu as cash retail customers, and then they've got a hardware store. And the hardware store is builders providers, and they need to insure all of that risk. So out of their, say, 10 million total turnover, about 2.5 to 3 million of it is risky. And that's what they insure. So they isolate that element. So that's the estimated insurable turnover. So when we're pricing up a policy, that's the first thing. The second thing is the level of bad debts. The questionnaire we fill in has 3 years to 4 years on it. So if you've had the insurers don't want you having a really bad 3 years of bad debts and then deciding I better get a credit insurance. They kind of want you to come into the fray with a reasonably clean book and then start buying credit insurance, and it's there to balance sheet protection in the background and to cover the anomalies. That said, when it gets to 3 years after a big claim, we would generally go to the market again to make sure we can get a good price for a client. So bad debts comes into it. So how much are we insuring in turnover? How many bad debts have you had? Are they big ones? If they were on cover for a big one, well, then that causes an impact on pricing. And then the main risks. So again, back to the single risk scenario where you've just got one customer who's $1 million and everyone else is all 50 grand, and that impacts the pricing. If everybody is a decent normal bell curve of a spread on your debtor book, well, then it's a normal pricing. There's no impact on it. Just it spit out the price. Exporters, then, if you're into foreign countries that are really unusual outside the OECD, anybody who is, if you're trading with Afghanistan or Brazil or Colombia or whatever it might be, anything that's a little bit off the beaten track, there tends to be an imbalance put into the pricing model on the premium. Separate to that, there is not only is it priced at I'll give you an example. It's between 0.1% and 0.5% of your insurable turnover, right? So if you want to do the sums on that, if you want, starting at a base price of around 6.5 grand premium up to whatever you want, right? So if you think globally, who insures? So you've got Samsung, Sony, Ferrero Rocher, CRH, they all have credit insurance, right? So all those big operators would have credit insurance in some manner around the world. And their pricing model would be, if they're dealing with different countries, it'd be broken down that way. The other cost in credit insurance, besides premium, is your limit application fees. So you buy every time you apply for a new limit on your policy, there's a cost to the insurer. Whether it's they are going out to get a third party report because it's a customer that they've never dealt with, or they've no information or financial information. They could be filing in Oman and they just have no real time information about that customer. So they have to go to a local Middle Eastern third party provider to send them a report. That report could cost £5,000 for them. They'll charge you something for that. Now, it'll probably be €80 if it's in the Middle East, it'll be €30 if it's UK and Ireland, or you can prepay at the beginning of two price costs in credit insurance. Insolvencies in Ireland. So this, I put this in just to not to put a bit of value around why you buy credit insurance, but just to understand what we're sold to as brokers by the credit insurers. So we get bombarded with this stuff. But I'm going to go to one later this month with one of the insurers. The first slide that show up is how many insolvencies have we been dealing with. It's actually not that bad at the moment, right? If you go back to pre-pandemic, we're only kind of creeping back up to where we were pre-pandemic levels, 2019-ish. We're at 875 last year. It's up a little bit on 23, but 23 was low because the government we're at the tail end of tax warehouse, VAT warehousing. We're having tail end of COVID support from the government. So there wasn't that many insolvencies in 21, 22, 23, but we are creeping back up a little bit. So the expectation is around 1,000 a year on average. So far in this year is 407 up to halfway through the year. It's down at 1% last year. 98% of those insolvencies are in the SME. So it's all that middle, small, medium enterprise and businesses that are going out of business, unfortunately. So SCARP, I'm sure you all have heard of it, and examinerships are up. So that it was a slow burn to get SCARP to take off. They were quite successful, those that were put in, but it just wasn't. It's only taken off in the last 6 to 12 months, really. We're seeing more of those now coming through, where there's a restructure of the business, whether it's examinership or under SCARP. They're insolvencies as far as credit insurance policy. So if you've got a customer, you're credit insured, they owe you 50 grand or 100 grand, they go into SCARP, that is an insolvency event on the policy, and therefore a claim will be paid out. If there's a recovery through SCARP of 3% or 10% or whatever the figure is, or examinership, that gets paid back later. In the meantime, you'll have got your cash reimbursed by the claim because it's an immediate claim event if the SCARP or examinership. It's the same as a liquidation or similar. Corporate receiverships are up. Liquidations have increased significantly. Court-led. Actually, a lot of these are coming from the creditors enforcing it. So somebody is owed amount of money. A lot of those are actually banks, second-tier banks, where they're stepping in, going to the court saying, I'm enforcing my security and I'm shutting you down. We're going for liquidation here because they want to realize their asset as soon as possible. Hospitality is a standout one for the last couple of years. Keep hearing about restaurants closing. They're really feeling at the moment. We have a couple of customers in sort of fish, seafood drinks, catering equipment, catering supplies. Those businesses are all finding a lot of claims the last couple of years. Hospitality is a real struggler at the moment. Other sectors are all about the same. We're finding it difficult to get cover in the construction sector in the UK, but Ireland is still hanging in there. What's coming down the line? Uncertainty, right? So I suppose this is trying not to paint too much of a dark picture, but I suppose when you're in my space, that's all we hear from the insurers is negatives. So I'll go back to the beginning and talk about, like, we obviously know where we are with tariffs and wars in the Middle East and everything else that's going on around the world. So that's obviously creating a level of uncertainty and a lack of investment in Ireland, a lack of investment by the companies, the global operators that are in Ireland, not to mention coming into Ireland. But on top of that, we also have saving rates apparently are high. So we as a people are hanging on to our cash. We're not spending. Consumer sentiment is down. So we're apparently, I don't know, I can't say that that's happening entirely in my house, but based on the couriers that arrive at the front door, but apparently spending is down, right? We have oil price in the Middle East. We don't really know what's going to happen in the Middle East over the next while. So oil prices, while they have been at quite a low figure, the 70 odd dollar a barrel, we could end up back at 120 if things go wrong, and that's going to really impact us. We're already, as a nation, we're already struggling with high energy costs. Hospitality is heading into a winter now where they're going to have to keep us warm if they want to feed us and put us up in hotels and keep the swimming pools warm and all that. There's a massive cost coming down the line with that. And we think that'll have a turning point into January, February. Once they've got the Christmas money into hospitality, could be some more insolvencies there. Warehouse debt, again, retail and hospitality were the two biggest uptakes of revenue warehousing. So that has come through in the last number of months, which is causing a problem where they have to pay back the revenue. It's not on the never, never. You have to pay it eventually. And then obviously tariffs is impacting some of our clients who are exporters for machinery and stuff, but semiconductors, tech devices, food, drinks, pharma, chemicals, a lot of that stuff that unless you're in that space yourselves, and the businesses you work for, they're apparently are really struggling with planning for the next 6 to 12 months and how things might play out over the next little while. Because America is it's a big market for us with a lot of these things, so it does have an impact.
Yeah, 5 minutes, James, just to.
Yeah, I'm nearly there. 8 to 10, yeah, not too much go. So what are we seeing? AI was mentioned earlier on with Dara. So AI, just as if you have a credit insurance policy, small limits below 20 grand, generally underwritten by an AI machine in the background. It's looked at the CRO and looked at the financial information available to them. Bit like the way CreditSafe, for those CreditSafe and VisionNet, they work off an algorithm. So that's stepped in now. We'll apply for a limit for a customer of ours for 20 grand. It just goes back approved if there's a positive enough trend and information. Risk appetite, as I said, is high in most sectors, UK construction aside and hospitality aside. The underwriters at the moment in the credit insurers are focused on cash versus the level of debt in the business. So obviously worrying about interest rates down the line while they're low at the moment, what could happen. Profitability is more important than the turnover growth. So I don't want to see you going from 10 million to 20 million. I want to see what profits have you made in the change. Underwriters are looking at December 23 accounts that are filed at the CRO now. Okay, we're into October. If you haven't filed your December 24s or a version of that, the insurers are just not writing new cover from somebody. They want to see up-to-date financials, which is understandable. A lot of the insurers will have management accounts, but if they don't, the decision tends to be no more cover. Diversification of supply chain. So they're worried about, when they look at a business, they're assessing, well, where are you buying from for your raw materials, and is that a concern? That became a big issue in COVID, and it's remained on the watch list now by the underwriters. We have credit insurance, because it's not so popular. It's a buyer's market. We call it a soft market, so the rates are low. Even though the risks are creeping up, the rates are still low. So we're in a nice place to buy credit insurance at the moment for people if they're interested in reviewing a policy. And we're actually finding within our clients and friends of our clients or contacts of our clients, a lot of our customers are people are asking us, I have supplier in Turkey I'm buying steel from, and they can't get credit insurance cover on me. Could you do me a favor and tell me why? Can you fix that problem for me? So we're doing a lot of that ourselves. So if you find yourself with a supplier side where you're not getting the supply credit that you want, we're getting those phone calls because we would have the relationship with the underwriters here who write the decisions. Other products in the market, I just wanted to just touch off it. Because credit insurance is obviously the premium rates are low, the insurers are looking for other ways to make a few bob. So what they've come up with is Allianz have brought in a new business fraud insurance, which is actually ridiculously cheap. And I don't think worryingly cheap, but I think it's a really good product for the value of it. It's definitely worth looking at if you don't have a policy that covers something like that. But it's something that you could bring to your management team or your directors around you as a suggestion if there's a meeting. Information services by Coface. Coface sell a policy of credit insurance where you're not indemnified, you're not insured, but you act as if you had a policy. So it tells you, you say, well, I'd like 100 grand cover on this company, and it says you're approved. Now you've no cover, but it tells you that if you had a policy, you would have got 100 grand. So it's like a dummy policy, right? We have them as brokers, we can get quick answers on buyers, but you can buy that product, and it's a relatively cheap. You buy similar to the way they price per application, they price per limit that you inquire about. And Allianz have brought in something similar that they're pulling into us next January. In January, I think we'll see it in the market as well. Not unlike that. That's credit insurance in a snapshot. I know I only had the 20 minutes or so, but it's not a very exciting topic. So I think that was long enough. We are, as I said, a broker, and we would put value in investigating having a credit insurance policy, even if you don't buy it. The process of filling out a questionnaire form with me or somebody, and going through the motion of getting a price, what you get is a risk appetite from 4 or 5 insurers. They tell you if you had a policy, it would cost you 5, 50, 100 grand, whatever the figure is. And these are the cover. This is the risk appetite on your top 20 customers. This is what we would write. And you might highlight something. Certainly 3 out of 4 insurers don't want to write cover on one of your main customers. Maybe you should take note.
Yeah.
So if anybody wants to inquire that from that perspective, happy to help.
Yeah. No, James, thanks a
Thanks,
million.
James.
We have got, so
Thanks.
I suppose if anybody has any questions for James, now is the time to do it. I see the thumbs up going up there for you, James. So look, it's just to give you an idea of what's happening in the real world, and I think, James, you hit the nail on the head. It's not just about bad debts; it's about information, payment performance, and like if Colfast says they're good for 100 grand, I'm happy with 100 grand. In terms of James yourself, because you're too nice to sell your own services, James, you're
we're free, by
unusual
the way.
in terms of you work for nothing.
Yeah, we're free. Yeah,
You're free. Well, free to
the
the
insurer
customer.
pays us 15% if you have a policy.
So for the punters out there, to engage your expert services and expertise and all that kind of stuff is not going to cost them any extra. You get paid by the insurance company, so there's no
Is
additional.
Declan frozen or am I frozen?
It's Declan's frozen.
It's Declan.
Frozen, am I?
Oh, there he is.
Sorry, you're back. You're frozen
back.
there for a minute.
You're frozen.
There I was.
The big
Okay,
sales
sorry
pitch
about
went in the bin
that.
there,
See,
Declan.
that's my machine telling me, Deck, you're 2 minutes over.
8
You have
o'clock.
to go home to finish the start the Monday night.
Thank you, Declan. The sales pitches. If you have a policy and you don't have a broker, happy to help. We're free.
Just
We can
even to
look
have
at
a look over it and point you in the right direction. And I know you'll give them the right advice and point them in the right direction. And so look, talk to myself, talk to James. I'll include your contact details when I send out the notes tomorrow. And look, we're all here to help each other, and that's what it's all about. So, James, appreciate your time this evening.
Thank you, Declan. Thank you, everyone, for your time, Steve.
And thank you, folks. Good night.
Thank
Nice
you.
voice.
Thank you, everyone.
Thanks, Declan.
Good night. Take care.